What's up everyone, welcome back to another video, and I'm going to give you some sauce on this trading stuff. A lot of you guys are confused on how it works, how can you make money with trading with money, so let's get into it. So one of the things that you need to learn when it comes to this trading stuff is key indicators and technical analysis. Reading stock charts, candlesticks, order types, trends, level 2 tape. AT is active trader, which if you use Thinkorswim is super detailed that you can execute your trades super fast. Tells you time and sales as well as level 2 live news. It'll give the company's data like how many shares are available, 52-week low and high, all that stuff. So introduction to candlestick patterns. Candlestick charts are a visual way to show price action over time. Each candlestick represents one time period and plots 4 prices: open, high, low, and close. The thick body of the candle spans from the open price to the close price, while the thin wicks extend to the period's high and low. This style clearly illustrates the battle between bulls and bears each period, making it easier for traders to spot trends, turning points. So when you look at this picture over here, you can see you have your chart right here, and this is a more in-depth description of what the candlestick is showing. So the components of a candlestick: a single candlestick has several parts: a real body, the rectangular part between open and close. If the close is higher than the open, the candlestick is bullish. If the close is lower, it's bearish. A long body means a big price change, strong buying or selling, while a short body means little change. The upper shadow wick, the line above the body showing the period's high price, the top of the shadow is the highest price reached. The lower shadow is the line below the body showing the period's low price. The bottom of the shadow is the lowest price reached. Open and close, the top and bottom of the real body mark the opening and the closing prices. Open and close labels show where the body begins and ends. The candle's color signals direction: green, white for up, red, black for down. Together, these elements tell a story of the period's trading. So this is what a bullish and bearish candle is. You're going to see a lot of this when you're trading. You're going to see it on your charts, but the color of the shape of the candle tells you if buyers or sellers were in control of that period. A bullish candle closes above its open. This means buyers dominated, the price finished higher than it started. A bearish candle closes below its open, meaning sellers push the price down. For example, a long bullish candle means strong upward momentum, while the long bearish candle means strong selling pressure. If the open and close are nearly equal, the candle is called a doji. So some of the times when you see an indecision, you'll see the candlestick have like a white wick. It'll look just like this. It won't have a long body candlestick. It'll just be a small dash between that candlestick. So these are going to be some of the candlestick patterns that you're going to see or in your trading journey. You're going to see a doji a lot of times. You're going to see doji, you're going to see a hammer, a bullish reversal. You're going to see a shooting star, which is bearish. You're going to see a bullish engulfing, which is when the red candle and you have a green candle, but the green candle is engulfing the red candle. You're going to see a bearish engulfing, which means that you've seen an uptrend, and then you're going to see a reversal to a downtrend. You're going to see a morning star, which is a bullish reversal. So support and resistance is the most important thing when it comes to trading. A lot of people like to buy off the support. Some people like to open up their short positions off the resistance. Some people, when it breaks that resistance level, you're also going to see people, it's going to switch. So that support level and the resistance level, that resistance level becomes a support level once that breaks, and people like to put their position size into that as well. So support is the price level at which demand is thought to be strong enough to prevent the price from declining further. Resistance is the price at which selling is thought to be strong enough to prevent the price from rising further. So these are some of the chart patterns that you're going to see when it comes to reversal patterns. The one that I always see the most is the double top reversal, as well as the head and shoulders top. But when it comes to momentum trading, we're not really trying to trade sideways. We're trying to get into the stock before the entire party shows up. So that's why I use my scanner, and I also think that this is like the best scanner because it tells you right away when a breakout's about to happen. So we're trying to get in before we have to deal with all this up and down hitting support and resistance. So the sooner you get into a stock, the better, and you can just ride the wave. And these are going to be continuation patterns. And this is also the one that I see the most, is the cup and handle pattern. You mainly see this when it's market open. I mainly like to trade pre-market because it's less halts going on. It's just kind of less volatile. But yeah, this is just a super quick little class on my course where I go super into detail about trading. I have a stock scanner as well as I do live trading, and you can just take a look at it for yourself. I have a link in the bio, but I am going to start doing more videos like this so you guys can kind of grasp how the stock market works. So be sure to like the video, comment, and subscribe, and I'll catch you guys in the next video.